Time to get some common sense from Craig on hedge funds. Craig Bolanos is the co-founder of VestGen, as well as a wealth advisor. Good to have you on our show each week, Craig. Let's start with the basics. What is a hedge fund?
That's going to be a private investment that pools together money, typically from wealthy individuals and institutions. And that hedge fund is going to have a diverse set of investment objectives. One hedge fund is not necessarily like the other, but these hedge funds go through more sophisticated techniques of leverage. That's borrowed funds, options, derivatives, and other items. And all of that is because a hedge fund doesn't have the same regulations that a normal mutual fund or ETF would.
Craig, you mentioned wealthy investors getting into hedge funds. On average, the investing amount tends to be $100,000 to $1 million. Isn't there a major risk here?
The risk-adjusted results, and in particular, maybe that's where hedge funds fall, Angela, risk-adjusted results, because a lot of investors are getting into hedge funds, not because they're searching for nominal returns, but because they're searching for real risk-adjusted returns. And that's a very important distinction to make, because there's a lot of criticism that maybe hedge funds don't say outperform the S&P. Well, making that comparison is kind of like apples and oranges, because there's going to be a lot of hedge funds whose goal is real return investing or market neutral investing. It's a whole bunch of gobbledygook, but it just means sometimes investors want to seek positive results regardless of the market outcome. So you can't weigh everything and score everything the same.
You're right about that. There are times hedge funds underperform the stock market, and certainly when the Reddit meme traders blew up some funds that were shorting GameStop and other stocks, those hedge funds were shorting, and that was a big problem as those stocks were going higher. What do people need to know about this investing strategy business?
Well, yeah, when we think of different strategies, I think about like long, short, that's 130-30. You're doing some leverage to go into your best picks and then shorting some sectors of the market or individual stocks that you don't think are going to do well to actually generate alpha or greater results. I think about things like global macro. Those are funds making large market-driven calls based on economic policy, think Fed rate cuts, et cetera. There's also event-driven hedge funds are things that trade, and again, trade, not just invest, based off political situations, conflicts that spark around the world, et cetera. So there's a whole host of hedge funds. They're certainly not for everybody, but for those who are looking to curate a diversified portfolio with non-correlated assets where you can have some things that zig when other things zag, maybe hedge funds make sense for a portion of someone's allocation. Well, if you want to learn more, as always, you can. And you know what? You should. Connect with us online at getretiredstayretired.com. That's getretiredstayretired.com.